We have hair. I have hair, everybody. I just want everyone. Hey, everybody. Come see how good I look. With my hair. Because I have hair. This is my hair, too. It grew back.
This is Ron Burgundy.
This is Ron. Hey, everybody. Billy's like, I'm here for support. Also, Ollie's in the other room, and I'm not interested in talking to Ollie right now because he ate my baby. Dingo babies.
Welcome to the Elite Life Podcast with your hosts, Trisha and Kylee. Here, we guide you on a journey of personal and professional transformation, revealing the secrets to success. Whether you're a seasoned pro or just starting out, join us as we unlock the doors to the elite world of growth, grit, and grace. So, let's dive in.
Welcome, friends, to another episode of the Elite Life Podcast. We are so excited you are here today. My name is Trish, and with me, as always, is...
I'm Kylee, and I love this shirt. I'm just throwing that out there. That's my new favorite shirt.
It's beautiful.
We're not talking about shirts today. We are going to walk you guys through the maze of mortgages. So, the reason we decided to talk about this topic is I don't think we've ever done an episode where we are distinguishing between this type of financing and that type of financing. And it's important because right now the real estate market is booming. And if you're thinking of buying a house in the next 150 years, which most of you probably are, you're going to want to know this because there are a lot of misconceptions about this type and that type. So we really want to do a deep dive to help you guys understand exactly what you're getting into.
Yeah, I feel like, you don't know what you don't know. And I feel like a lot of people don't know that there are actually multiple different kinds of mortgages you can get.
Because you're like, a mortgage is a mortgage is a mortgage is
right,
a mortgage.
Right,
right?
You got to pay a bank.
30 years to pay this bank off. Bing, bang, boom. But there are ins and outs to all these different types. So we want to jump in, and we're going to be breaking down conventional, FHA, USDA, and VA, and bridge loans. So we got a lot to go through, so strap in.
Yeah, I never even knew that bridge loans were a thing until actually very recently, and I worked in the mortgage world. So this will be helpful to everybody because at some point in time, even if you plan on living in your house forever and ever and ever, you may want to refinance or something of that nature. And in Michigan, and today, it's 2024. If you're listening to it the day it comes out, it's July 2024. And we are in a space where rates have been slowly but surely trickling down. And I was just talking to our mortgage rep yesterday or the day before, and he was saying that we have more cuts that are coming up. And so knowing these ins and outs and the differences and what you can do if you want to is really important. So starting with conventional mortgages. So conventional mortgages are what I would say are the most relaxed guidelines to be able to get a mortgage. So
because the government's not involved.
Correct. The government is not involved in these. And conventional mortgages are mortgages like if you go to, for example, Bank of America or Chase or, any of those like big box named mortgage companies, likely what you will be getting is a conventional mortgage. Now, not to say that those banks don't do other types, but I would say that they're bread and butter is a conventional mortgage. It's not backed by any government agency. It's going to be like Fannie Mae or Freddie Mac underwritten, which doesn't really matter to you. But what it just means is there's more relaxed guidelines on the house itself, meaning they're not going through there and going, oh, all the paint has to be perfect and this has to be perfect and that has to be perfect.
You can buy a box of cat crap with a conventional mortgage.
That's correct. So the major advantage to a conventional mortgage is flexibility. Variety of options, including fixed or adjustable rates. So a fixed rate means you have the same payment no matter what for as long as you have that loan. An adjustable rate or an ARM means, you have a fixed rate for a certain amount of years. So like you might be on a 2-year ARM. So for the first 2 years, your payment's $1,200, and after that it adjusts, and it could adjust to $1,400, $1,600, $1,800. It's whatever the prime rate is at that time. Another advantage is you can often avoid PMI, private mortgage insurance, if you put down at least 20%. So don't just look at the interest rate, guys, because you might get a lower interest rate on an FHA mortgage today, a higher one on conventional, but because FHA has PMI, that's additional money that's going to go on your monthly payment. So your interest rate to interest rate might be a 6 to a 6.25, but the PMI is pushing that 6% payment up higher than that 6.25 one. So don't just look at one piece. You have to look at the whole thing. What's the interest rate? What's the breakdown in the payment? Is there PMI or not?
So real quick, just side trail, just to break this down, private mortgage insurance is a type of insurance that lenders typically require from homebuyers who obtain a conventional mortgage loan and are unable to make at least that 20% down. So here's some just super quick rundown. I'm going to run down this list super quick. So the purpose of PMI, it protects the lender, not the borrower. It compensates the lender for potential losses if the borrower defaults on the loan. So it's required when you are putting less than 20% down. That means the loan to value ratio of the mortgage is higher than 80%. So the cost of PMI can vary based on several factors, right? So including the size of the down payment, the loan amount, your credit, the loan term, and it's typically added to the monthly mortgage payment, like Trisha said, but it can also be paid as like a one-time upfront premium or a combination of both, okay? And then there are different types of PMI. We're not going to go down these rabbit holes, but just so you can hear the lingo, like when you're having these conversations with your lender, the different types are borrower paid PMI, lender paid PMI, single premium PMI, and split premium PMI. And like each type has different payment structures and terms. That's a whole nother episode. That's a whole nother conversation. Benefits and drawbacks really quick. The benefits are the PMI allows the buyers to purchase homes with a smaller down payment, which can be beneficial for those who just don't have the liquid to do that full 20%. And then the drawbacks are obviously it increases the monthly mortgage payment overall for the cost of the loan.
Yeah, and I would say, one of the harder things about conventional is you do need a better credit score to get a conventional mortgage. So typically like 620 or higher, and your down payment can be smaller though. They have 1% down conventional mortgages, 3%, 5%, and so on, 20%.
So you can qualify for a smaller down payment.
Yeah, 1%. So that's like a pro is you only have to put 1% down on some conventional mortgages. But
then you're getting that mortgage insurance put on.
Yeah. But you know what? When you're putting 1% down, basically when you're putting less than 20% down, every single mortgage is going to have PMI. I don't know any of them off the top of my head if you're less than 20% that don't have some sort of PMI.
Absolutely. So just to sum it up, conventional mortgages, they offer flexibility, the possibility of avoiding paying for PMI, but they do require a higher credit score and a substantial down payment. Boom.
Next up, FHA. So
FHA. So this one is probably the most common, I want to say. Most of the people outside of my investors that I work with are FHA, at least right now. What about you?
It depends on the price point, I would say. I think that your more blue collar working class borrower is going to be doing FHA, and your more people that are like going from one house to another house, they have that equity built. They're going to go into conventional to get that better rate and drop that PMI. Or if they have higher FICO scores. So the higher credit scores and the more substantial amount down are going to be your conventional buyers, and your working class, first first-time home buyers, things of that nature with lower FICO scores are going to be your FHA loans. So it really just depends on, what market you're working in. I had a listing in Westland, and it was very much a very working class area. And my client's like, well, we maybe shouldn't accept FHA loans. And I'm like, then you're going to have 2 clients that come through, because there's probably only 2 people that are looking in this neighborhood in this area at this price point that are going to be conventional, because usually if you're a conventional buyer, you're in a higher price point. So for me, usually more of my buyers are conventional, just because I work in higher price points. But I would say 8 out of 10 of my first-time home buyers are FHA clients.
Absolutely. So the benefit of the FHA is lower down payment, and there's more lenient credit requirements. Those are probably the biggest benefits. And then they also allow higher debt to income ratios compared to conventional loans.
Yeah. So what that means is, like, you don't have to make as much money. That's why I say, like, you're working class citizens. You don't have to make as much money as in comparison with what you spend. Your debt to income ratio is, they take all the money you make for the year and they divide that by 12 for your monthly income. And then they cut that in half. And that is how much money you're allowed to use for your debt to income ratio. So if you cut that in half and you say you have your yearly income, you divide it by 12, and then you take that 1 month of income and you cut it in half and say it's $5,000. Then they take that $5,000 and they subtract all the bills that are on your credit report. So your car, your credit cards. They do not take off utilities and things like that, but whatever is left over is how much they say you can have for a house payment, right? So an FHA might be, you can go up to, 50% debt to income ratio, whereas conventionals, like, no, we're giving you a better interest rate, we're only making you put 1% down, but we want to see you only have a 40% debt to income ratio so that you have more disposable income, right?
Yeah.
Because it's all about that risk factor. FHA is willing to take more risk because they're government backed. So they're the government. Like, if they have to take a house back, not a big deal. If Bank of America has to take a bajillion houses back, that's going to be a bigger deal than if the United States government has to take a bajillion houses back, right?
Gotcha. Okay. So what are, let's talk about the drawbacks really quickly on an FHA. Mortgage insurance premiums are the key downside. You'll have to pay an upfront fee and monthly premiums, which can add up over time.
Yeah, so you have MIP and PMI. And most of the time, again,
LMNOP, ABCDEFG.
I know, and people aren't necessarily gonna know this or maybe even realize it, but if you're in a good position where you have a great FICO score and you have some money to put down, these details can definitely matter.
100%. So let's dispel the myth. Here we are with the myth of the FHA inspection. I learned early on, because Trisha does amazing training, that FHA does not have a separate inspection. I'm constantly hearing this from my FHA buyers. Oh, when is the FHA inspection? I'm like, not a thing, homie, not a thing. So what happened is you have your home inspection, which is your private inspection. When the appraisal comes for an FHA appraiser, they don't just give you a valuation. They are looking for things, like I explain it to my buyers like this. They are looking for things that are going to impede your use of the home or are going to keep you from paying your mortgage payment. So if there are things that need to be fixed around the home or things that are not like up to code, those are the things that they will give you a list. They say, fix all these things before we underwrite the loan. So when you are, am I wrong?
No, you are. I always say, like, health and safety. They're looking for health and safety.
Exactly.
If you can fall down the stairs, there's no handrail. If a kid can eat peeling paint, which I know sounds crazy, but I had a tenant one time call and say my kid just ate the peeling paint from behind the toilet. So peeling paint is a no-no. Broken windows, a kid puts their hand through
rotting wood.
No, rotting wood. Health and safety standards are like the big thing they're looking for.
Absolutely. And a lot of times they are things that you can easily take care of, depending on the terms that you put forth in your purchase agreement. The buyer could be responsible for taking care of those. Like when Ryan and I bought our house, we were FHA. Ryan obviously is super handy, so we let the sellers know, hey, if there's any FHA required repairs, we will take care of those. Or you can ask the sellers to do it, right? You can put it in your purchase agreement that if there are any FHA required repairs, the sellers have to take care of that.
Yeah, and I always explain to my clients too, like, there is not an FHA inspection. However, when they go do the appraisal, they are going to have FHA health and safety guidelines and standards that home must go by. If something is cited at that point in time, it reopens negotiations on the property to say, okay, the seller's going to handle this, or the buyer's going to handle this, or, oh my gosh, it's the dead middle of winter in Michigan. Nobody can paint or pour cement, so we have to escrow for it. So it is a point in time, there's only so many times in the contract where negotiations are actually reopened. This is one of those maybe 2 spaces that they will be.
I will tell you, when we bought our house, they hit us for some peeling paint on the shed, and this was the middle of March. And for those of you who don't know what Michigan looks like in the middle of March, it is a snowstorm. It is a complete snowstorm. So I remember Ryan was looking at the weather. He's like, okay, me and Phil can get out there. They painted this shed, tarped it off, and literally hours later was when we got like 3-4 inches of snow. So it is doable. But again, you just want to make sure that you're keeping an eye out for these things as you, the buyer, are walking through, or you're the agent walking through.
Yeah, for sure. And that brings us to, so FHA loans are really great, like I said, for buyers with maybe a little bit lower credit, a little bit less down payment. They'll come with a little bit of additional insurance costs, but it's probably going to be worth it for you.
Totally worth it.
Be able to move into a home that you own as opposed to renting. Because remember, guys, as we always tell everybody, rent is a 100% interest rate. So whether rates are 6, 7, 8, 10, 11, 12, and you include insurance, and that makes it 15 is still less than 100. Okay, 15% interest with insurance is less than 100% rent that goes to your landlord and you get nothing from.
Absolutely. So let's break down USDA loans. I love these. Have you done one in a while?
I have not done one in a while. Rebecca Vincent's doing one right now, so I've been walking through it with her.
So basically,
she's in the country.
She in the country. So speaking of the country, that's what these loans are for. So they're a fantastic option if you're buying in a qualified rural area. One of the best perks is that they offer 100% financing, which means you're not putting anything down, right?
Correct, right. Rural development is sometimes what they're called. USDA loans, rural development.
So there are some hoops and some qualifiers. So number 1, they are income and location restricted. Yep. So you have to be below a specific income, and you have to be in an area where they are offering that loan. So most often you're not seeing these in downtown Detroit. No. You're not seeing these in the suburbs, the cities. We are talking about areas out in the country where they're trying to get some more people out there.
Yeah, it's all rural or semi-rural areas. If you have, a barn out there, it's probably going to be a good space for it.
So obviously the benefits are, and I've had a couple clients who qualified for these. We didn't end up using it. We ended up using FHA. But you want to make sure, again, that when you are looking at homes, you're looking at listings, that they are accepting those types of loans. Because, like we said, you have no down payment and you have lower interest rates.
Yeah. So if you're in that area and you're in that income level, that's going to be a perfect one for you. And another 100% loan we have are VA loans, which we love our veterans.
Thank you,
VA
veterans.
Loans are for veterans. Thank you for your service.
Absolutely. So they're mostly known for their favorable terms. So let's break down the pros and cons of these ones.
Yeah. No down payment. No PMI, and they have competitive interest rates. They're very good, and they're much more lenient on your credit requirements. So they're going to be easier for our veterans to get, which they deserve. They also are going to say what veterans can and cannot pay for. So like a seller is supposed to pay for a pest inspection, right? Veterans don't pay admin fees, things of that nature.
Yeah. So what's the VA funding fee?
The VA funding fee, it can be paid upfront or rolled into the loan, but it's just an added cost to be aware of. It very often, like they don't even see it. It's just rolled into the loan a lot of times, kind of like a real estate admin fee. It's the VA is charging a cost basically to send the money to the title company and fund the loan.
Gotcha. Okay. So they're obviously ideal for qualifying veterans and service members due to, their favorable terms, and the funding fee is something to consider. You want to make sure, depending on how long you were in the military, what your discharge was, like there are some things that you need to qualify for that you definitely have to talk with the lender about for sure.
Yeah, definitely. And then just like FHA, know that VA appraisers are going to they will cite health and safety standards. And you do have to, this is the only loan where you have to have a pest inspection no matter where you are. And the seller is supposed to pay for those things.
Gotcha. Okay, really quick. Bridge loans.
Yeah,
These
bridge
are
loans
super
I didn't
fun.
know about. This is a really cool new thing. And they are a short-term loan to bridge the gap between buying a new home and selling your current one. So in this market, it is very hard right now today to get a house accepted, an offer accepted, contingent on closing your other house. So this is a way for us to say, you know what? I don't have to write my offer contingent on closing my other house. I learned this. I was doing Trent Scully Coach's dad's loan, and they own their house free and clear, and they wanted to buy a condo. They were getting a smaller property. So they knew, hey, our house is going to go quick and fast. We owe nothing on it. Let's pull, $180,000 bridge loan. It only cost $1,000 to fund a bridge loan. So it cost them $1,000. They were able to close their new condo
using the equity from the previous house.
Yep. And it's just like a cash offer. So basically you're offering cash on the property. You're pulling a bridge loan because the house is free and clear, and you're closing on your condo in 2 weeks or even 7 days.
Right.
And then you have the time to move slowly, especially like they're senior citizens, right? Like it's going to take them a little while to get all of their lives out of this house they've lived in for 50, 60 years or whatever the case may be, all their kids' crap. So it's going to take them time to get everything out.
Hey,
move
John,
it over.
come get your crap out of the basement.
Exactly. And they didn't want to be rushed doing that. And they didn't want to miss out on the condo that they wanted. So they were able to get the condo they wanted at the price they wanted, basically pay cash, pull the equity out of their house. And then I listed their house, sold it, and it paid off the bridge loan.
That's amazing. Bing, bang, boom. All right. What's next? I think that's it. We hit all of them.
We're rock stars.
Boom, shakalaka. So I hope this was helpful for you guys. We really wanted to break this down because right now the market is hot and it's just going to keep getting hotter. The interest rates are coming down. So like we said at the top of the show, if you are planning on buying a house now or sometime in the next 150 years, you're going to need to know this. And we wanted to make sure that everybody understood what they were getting into, dispel all the myths and the mysticism surrounding this. Loan officers should not be the only people who have all of this knowledge. So I hope this was helpful for you.
Yeah, not all loans are created equal. And don't take the first one that is offered to you either. I would make sure, re-listen to this podcast and write down, okay, I'm going to talk to this lending partner and this lending partner, because there's also a difference between banks and brokers. We're not going to get into all of that. But, if you go to this broker, they're going to have different banks they send their loans to. If you go to this broker, they're going to have different banks they send their loans to. And if you just go to this bank, they're going to have different things. Or if you go to a credit union, they're going to have different things because they lend their own money and they make up their own rules. And it's not any of the things we talked about. We didn't mention credit union.
Yeah. So make sure you shop around and get the best financial fit for you and your family.
And make sure that they're doing soft pulls if you allow them to pull your credit, because a hard pull will hit your credit score, but they are able to do a soft pull and just inquire about where you're at and have that conversation of what do you want to put down and what are the benefits to putting down more money, money, or getting maybe missed a down payment homeowners. We didn't talk about down payment assistance programs, but there are down payment assistance programs, grant programs, and what are the pros and cons to utilizing these along with these different mortgage options? There's a lot of things. So I guess above all else, like, speak to a professional. And if you don't have one, give me and Kylee a call, drop us a message, shoot us an email, text message us, smoke signals, whatever. We will point you to one of our partners. Our partners are licensed in all of the states in the U.S., and they can walk you through all of these different loan options and all of the different payments and programs and down payments and interest rates and ins and outs and pros and cons, because it is not a one size fits all, and you really want to be educated and take your time with it.
Yeah, you're buying a house, not a hamburger.
Yes.
Boom. And with that, we are going to wrap up. We're so glad you joined us today. If you like the show, share with a friend, subscribe so you don't miss a single thing, because we drop fresh content every Thursday. And so we'll see you next Thursday for another episode of The Elite Life.
Bye. What is that? This is my chest. I need some water.
Jazz.
I ran out of water.
Thank you for joining us today on the Elite Life Podcast with Trish and Kylee. Don't forget to share this episode with a friend so we can keep delivering you more fantastic insights on grit, grace, and growth. Stay connected with us on Instagram and Facebook, where we'll keep the ideas flowing to help you build a life you love and leave a legacy you can be proud of. Until next time.